Welcome to the special Tuesday edition of Monday Morning Quarterback. I'm Rob Flutie, your mortgage quarterback, and today's February 20th, 2024. Markets were closed yesterday for President's Day. This week's economic scene is on the quieter side, but let's chat about last week's highlights. January saw new home construction dip to a 5-year low, affecting both single and multifamily projects. Yet, the National Association of Home Builders is optimistic, predicting a rise in single-family home construction throughout the year. And here's the silver lining. Building permits for single-family homes soared to a yearly high, up 35.7% from January of 2023. That's some promising news, folks. Home builder sentiment also made headlines last week, hitting a near optimistic 48. Remember, a score of 50 means thumbs up for the market, while below 50 suggests a bit of a frown. But hitting 48, that's the best we've seen in a long stretch, inching us closer to a brighter outlook. On the inflation front, the consumer price index tickled the markets in an uncomfortable spot, pushing mortgage-backed securities on a wild ride and nudging interest rates upwards before settling down. The producer price index also stirred the pot, ending our week on a less than stellar note. Mortgage rates felt like a roller coaster last week indeed. It's crucial to note, though, that the Federal Reserve keeps a closer eye on core PCE over CPI. Due to its different approach to calculating inflation, especially concerning shelter costs, despite CPI's heavy weighting towards housing costs, real-time data sources like CoreLogic and Black Knight suggest a more moderate increase in rents, challenging CPI's higher figures. Last week also brought us MBS Highways Housing Index, a survey taken of over 3,000 realtors and loan officers nationwide, conducted just last week, with buyer activity nudging up and home prices reaching new heights. It underscores the enduring strength of the housing market despite inflationary pressures. Looking ahead this week's economic calendar, it's light with a few key events, including a bond auction and the release of the Fed's meeting minutes on Wednesday. Existing home sales data coming out Thursday, along with the jobless claims. As we wrapped up last Friday, the markets gave us some mixed signals, yet there are indicators of potential improvement. For those of you working with clients, especially those on the brink of affordability, it's crucial to stay updated on the latest interest rates to ensure they still qualify for their dream home. Let's take a look at the charts this morning. Thus far, we're up 17 basis points. We're off to a great start. And remember, the higher the mortgage-backed securities go, the lower the interest rates are. As we approach this Fibonacci level, if we can break above that level of resistance, we have a lot of room to the upside before we hit the next level of resistance. So let's hope we get a little bit of momentum, break above that Fibonacci level, and get a little bit of momentum by our side. Now, looking at mortgage rates, Mortgage News Daily, which updates their rates daily, has the 30-year at 7.14%, 15-year at 6.55%, 30-year FHA at 6.65%, Jumbo at 7.4%, and the 30-year VA at 6.7%. We also have Freddie Macs, which update weekly, showing their 30-year at 6.77% and their 15-year at 6.12%. But summary, while this week may be quieter, it's a time to stay vigilant and prepared. Whether you're buying, selling, or keeping an eye on the market, remember the landscape is always changing. That's it for today. Wishing everyone a fantastic week ahead. Stay tuned, and I'll catch you on the next Monday Morning Quarterback.